Hello, everyone. My name is Vaibhav Puranik, and today I'm going to discuss with you uh, how to navigate economic uncertainty in 2025, especially for high-earning professionals. Right? They invest certain portion of their income every year, and they need to know where to invest that money based on the current situation. We actually produced a report on this recently, and even though this is the same content, instead of just reading the report, I'm going to just try to discuss it a little bit more so that people can understand what I mean to say in that report. So yeah, first section of the report was just what is likely to happen in U.S. economy in 2025, and really the crux of it is that the tariffs have been announced, and some of the tariffs have been taken back, but still some of the tariffs, especially on China, remain intact. Now there is a possibility that even that tariff might go away, but the vehicle, there were tariffs announced on 25% tariffs on vehicles, right? The vehicle parts that are coming into the United States, and those tariffs are here to stay. So we're not sure if the tariffs are completely going to go out, right? Some tariffs may remain. And what will be its impact on the inflation? That's what I'm worried about a little bit. And I think there will be a mild inflationary impact, even if tariffs are canceled. Also, the economic activity will slow down, even though the economy grew it grew in the first quarter. The activity will slow down because there's uncertainty, right? And as a result of that, investments will be pulled back a little bit. And as a result of that, we think that the Fed rate cut that was going to come later this year, we're not sure if it's going to stay or not, right? I mean, it may not materialize, it may be delayed, and that means we're here, the high interest rates are here to stay. And that's why, because the borrowing is expensive and the trade dynamics are shifting, it's time for caution and thoughtful decision making. Now, what about stock market? Now, because the previous growth in last couple of years of stock market essentially came from like tech companies, a few tech companies really, while many others are lagging behind. And this means that growth was not robust, it was fragile growth, and it's susceptible to swings. And because there's a lot of global uncertainties in play, stock prices are probably going to be volatile throughout the year. And so what you'll see is like government will announce something, the stock prices will either go up or go down in a big way, and then maybe in a few days it'll recover or not. So there'll be a lot of volatility going forward in 2025. So then if that's the case, then is the stock market safe to put all the money in, all the extra money that you have in 2025? I say not. I mean, of course, you can try to catch the dips and, try to invest some money and then hope that the market actually recovers, but that may not happen. Just remember that, right? So then usually what happens is investors flock to safe haven assets in these kind of times. Now, the top three safe haven assets is like you have short-term US treasuries, somewhere around 5% yields. It's a less risk than long-term bonds, right? Then, of course, high-yield corporate or municipal bonds. They provide steady income, and they have a lower default risk. If you get really, really big companies, like, with trillions of dollars of market cap. They're probably not going away anywhere, right? So you can get those bonds. And of course, there's a cash or money market funds, right? They'll offer you steady liquidity. They'll offer you liquidity and protection against market drops. Now, you might notice that I didn't say gold here. Gold is a safe haven asset, but the reason I'm not saying gold is because gold is already at its peak, and I don't know how long it's going to sustain that way. It might not. And plus, gold is not a productive asset; it's a store of value. Really, it's not an investment. So that's another topic we'll discuss about that. So what about real estate then? Like, should people invest in real estate? I do think. Look, I'm a believer in real estate. There's no reason to think that I'm going to not advise you to invest in real estate, right? I like real estate. I've invested in the process where at this moment when I'm speaking about it, I'm actually buying real estate for myself, investment real estate for myself. We also have another syndication in works, and that syndication is going to buy real estate as well. So I'm not just preaching this, but I'm doing it myself. We think Class B multifamily apartments is a good investment. They're not going anywhere. You need to be in an affordable range. So if you are in affordable rental range, then you're going to remain in high demand. They attract reliable tenants, either lower middle class or middle class, white collar jobs tenants, then they'll be okay. And plus, if people start losing their houses, where will they go? They'll go to multifamilies, right? They'll go to apartment complexes. So Class B multifamily apartments we think, are here to stay. They will still deliver. They will deliver consistent returns. Necessity retails, right? Meaning grocery stores, pharmacies, service-based retail. Those centers, those are necessary things, right? So those are important. Senior care facilities, right? That demand is going to stay, right? Because it's recession resistant, right? You have more and more people becoming older, and you need these centers to take care of them. They are long-term care needs, right? So of course you have to look at the operator with stable occupancy, their strong reputation, their record, all of that stuff, right? Yeah, but those are some of the real estate safer options, I would say. Now, what are the riskier areas? Office buildings. Now, yeah, I mean, of course, back to work movement have started, right? But hybrid work is here to stay, and some companies have chosen to be full-time remote. So I think the capacity that was created before pandemic hit was way more, and we might not need the full capacity, right? Even when companies are starting hybrid, if people are going 2 or 3 days, they might not need the full capacity, right? They'll just assign those days to various people, and then it is reduced capacity. So office buildings remain risky. Anything luxury retail, hotels, those I would be wary of, because it's sensitive to economic downturn. Now, another thing is location. I know this is a cliche, but you need to focus on areas experiencing strong population and job growth. Real estate is highly localized. Like, for example, there could be a city, where it's all like going down the hill and this, not performing well, but there might be some neighborhoods in the city that are doing extremely well. So it's highly local. You need to understand the dynamics of a particular neighborhood or locality. I would say that proximity to work centers, employment centers, is going to be, key driver for demand. So location, when you're analyzing your location for real estate investment, make sure it has employment nearby. Now, for real estate investors, right, my advice is divided into two different kind of investors. One is for active investors who are buying and managing their own rentals, versus the passive investors who are invested in syndications and other passive sort of avenues of real estate. So for active investors, I would say focus on lease renewals rather than pushing for higher rents, right? Listen to your property manager. If they're telling, no, let's not increase the rent this time, then don't do that, avoid variable rate loans. I mean, sometimes our variable rate loans are important, but make sure that it's like 4 or 5 years away, the rate expiry. Maintain strong cash reserves. You have to have at least 6 months of expenses for unexpected cost, and you should prepare for high long-term holds, right? I mean, anything that turns around in 3 to 5 years, if somebody's promising you that, or you're putting that in your underwriting, then I think it's a wrong time to do so. You need to wait for like 5, 7, 10 years timeline. Now for passive investors, again, pick the strong syndicators. Like, you need to make sure that the people who are running your show of your multifamily or whatever syndication you're investing in, they have enough experience. They have gone through the various economic cycles. They know how to change behavior in certain economic cycle. Diversify, right? Again, diversify asset classes, regions, apartments, senior care, necessary retail, so those asset classes as well as regions as well. I mean, Modesto, Los Angeles, whatever, right? California, non-California. Yeah. Invest everywhere so that it averages out. You can consider debt-based investments, because in real estate you have equity-based and debt-based investment. In equity is when you invest in a syndication, whereas debt is when you give a loan to somebody. Now, when you give a loan to somebody, then it's a fixed rate of return, right? Guaranteed, and you have a lien on the property. So then, you can guarantee that you get paid first, even before the investors get paid, right? So consider debt-based investments, and if somebody wants to understand debt-based investments, please come and contact me. I will talk more about how to debt-based investment. There are some websites also like prosper.com which allow you to invest in debt-based stuff, but that could be a little bit risky, but I can explain more about this later. And understand the exit plan. I mean, just make sure, again, here also, like, prepare to be hold for a longer time. You need to have some flexibility in timing. Okay. If this is not a good time to sell, then don't sell. Just hold on for a couple of years more. That's the beauty of a real estate, right? You can't go wrong. Just hold it for more years. Yeah. So in conclusion, right, 2025, the key to investing is resilience and selectivity. The economy is stable right now, but it's facing headwinds. Stock markets are going to be volatile. The safe haven assets, such as certain type of real estate, certain type of bonds, and will offer reliable path forward. Stick to quality investments, minimize risk where possible, and plan for longer term. That's it. And those were my few words. I just want to quickly read a disclaimer that whatever I said today was for informational purposes only, and I'm not your investment advisor. So you should not keep, any of this. It does not constitute a financial, legal, or investment advice. The views expressed here are subject to change without notice, and readers are encouraged to conduct their own research. And Old Money Capital LLC and its affiliates assume no responsibility for any liability or any actions taken based on the information provided herein. Okay. Thank you very much.